So for the session today, we have a personality who advises and represents various clients on income tax matters with a focus on transfer pricing and international taxation. She has successfully argued and defended clients across various appellate levels and has previously worked with PwC, EY, and headed the Global Transfer Pricing Center at Philips India. With a career span of over 17 years in transfer pricing, international tax, and dispute resolution, the feathers to her crown is innumerous. She is none other than Ms. Bhavya Bansal Goyal, founder of BBG Tax. Ma'am is a special invitee member of the International Tax Committee of the Western region of ICAI and contributes monthly to the transfer pricing updates column in the ICAI newsletter. Ma'am also holds a diploma in international tax, a certificate in alternate dispute resolution, and is a certified mediator and negotiator from IICAI. Ma'am is an active speaker at various forums on topics related to tax litigation, transfer pricing, and alternate dispute resolution. Ma'am, we are truly elated to have you. Today, we also have with us Ms. Kriti Chawla, Assistant Professor of Law, Jindal Global Law School. I welcome you too, ma'am. Without further ado, I now request Bhavya ma'am to kindly enlighten us and walk us through her article, Non-Recognition in Transfer Pricing, Substance over Form. I also request all the participants to kindly post their questions in the chat box and we'll take them at the end of the session.
Thank you, Supriya, for such a detailed and a good introduction. It is so good to be addressing all of you. A very good evening to everybody. And I hope I'm able to add some knowledge to all of you. Hope everyone is doing well and keeping safe and enjoying the weather. Okay, so let me start by giving a brief background on the article for which we are having this webinar today. As you are aware, the article titled Non-Recognition in Transfer Pricing, Substance over Form has been published on the CCIT blog, The Tax Terminal. I was reading recently that transfer pricing audits will attract increased scrutiny since already governments are grappling with rising healthcare expenses and fiscal deficits. So we would need to be more careful for our transfer pricing audits nowadays. In the context of income tax law, the principle of substance over form allows tax authorities to disregard the written contractual terms between parties and identify the true nature of the transaction and recharacterize or disregard a transaction. So with the ever-growing emphasis on substance over form and commercial rationality globally, there is an increased focus on the actual conduct of the parties, functions performed, and risks assumed. In these times, such as COVID pandemic, when profitability is impacted to a great extent, it has become even more important to justify the commercial rationality of an international transaction. So with that in mind, I had written this article. So what does non-recognition actually mean? It means that the tax authority may set aside the contractual terms of a controlled transaction and look into the actual substance of the transaction. It means that the tax authority may reject the paper form of the transaction and look at the actual conduct of the parties to find its true substance. If the transaction is not considered commercially rational, the tax authorities may either completely disregard a transaction, or they may disregard the actual transaction and substitute another notional transaction which the tax authorities feel is closer to the substance that might be expected if the taxpayer had been dealing at arm's length with an independent party. So the whole concept of non-recognition is outlined in OECD transfer pricing guidelines. Para 1.122 to 1.125 sets out circumstances in which transactions can be disregarded. though it emphasizes on the fact that non-recognition should be done only in exceptional circumstances. So we cannot do non-recognition by way of a routine exercise or in normal circumstances. You may also refer to section D.1.1, which provides for contractual terms of the transaction. It gives guidance on whether the contractual terms of the transaction meet the actual substance. It says, where a transaction has been formalized by the associated enterprises through written contractual agreements, those agreements provide the starting point for delineating the transaction between them. It also says that the terms of a transaction may also be found in communications between the parties other than a written contract. So the main crux of this whole guideline related to non-recognition is that whether the actual transaction possesses the commercial rationality of arrangements that would be agreed between unrelated parties under comparable economic circumstances. Transaction can be seen between two independent enterprises under comparable circumstances. The transaction will not be disregarded. However, the only fact that the transaction is not seen between independent parties does not mean that the transaction should be disregarded, because the related parties have the flexibility of structuring a transaction in peculiar ways, different from how independent parties would do. Now, let us discuss some examples to throw some more light on this concept. First, I'll take an example of IT-enabled services, commonly known as BPO. So, in the past few years, there has been increased litigation on whether a particular transaction is BPO or KPO. KPO is knowledge process outsourcing. So, depending on the type of the employees one hires, for example, or the services one provides, the classification can be done. For example, if it is a pure customer call center, it will be classified as a BPO. However, if it entails more than that, such as probably they are providing some research based services, then it will be classified as a KPO. So it is determined whether the services are low end or high end. And the reason why the tax authorities want to reclassify BPO as a KPO is that KPO commands a much higher percentage, a higher margin than a BPO. Reclassification from BPO to KPO has been upheld in the case of McKinsey by the Supreme Court. Similarly, another common issue is related to contract R&D. Tax authority disregards the low-end cost plus function approach followed by taxpayers. Post the BEPS Action Plan 8 to 10 on intangibles and the Development, Enhancement, Maintenance, Protection and Exploitation, commonly known as DEMPE analysis guidelines, there is an increased focus on the actual functions performed and depending on the actual substance of the transaction. Recharacterization of the entity is undertaken and a profit split analysis may be followed rather than the standard TNMM analysis. Another example I'm citing from the OECD transfer pricing guidelines is of a company that is situated in a high risk area subject to floods. So it holds a lot of inventory as well as assets. So due to the high financial risk involved, there are no third party insurance companies which are willing to provide insurance in such circumstances. Hence, the company is paying an exorbitant insurance premium of almost 80% of the value of the goods to its associated enterprise. So the form of the transaction is insurance premium. However, if you look at it from the eyes of a common businessman, no prudent businessman will pay 80% of the value of goods as an insurance premium. Hence, the tax authorities will disregard this kind of an arrangement since it does not meet the commercial rationality principle. Also, the fact that no independent entity would pay such a high premium to a third party becomes relevant here. Hence, the substance of the transaction, which looks like it is shifting of profit outside that jurisdiction, comes into play. Initial cases on non-recognition concept within the transfer pricing arena was of Eli Lilly and Company. It's a 1998 decision by the United States Courts of Appeal. In this case, a pharmaceutical company in the US, Eli Lilly and Company, transferred valuable pharmaceutical patents and manufacturing know-how to its subsidiary. IRS argued that the transaction should be disregarded in light of substance over form principle and claimed that all of the income from the transferred intangibles should be allocated to the US parent. Now, the judgment from the tax court held, I will quote, respondents' argument that petitioner having originally developed the patents and know-how is forever required to report the income from those intangibles is without merit. Respondent ignores the fact that petitioner as developer and owner of the intangible property was free to and did transfer the property to the Puerto Rican affiliate in 1966. Unquote. The Court of Appeals altered the judgment from the tax court. So, according to the Court of Appeals, the parent company had received an arm's length consideration for the transfer of intangibles in the form of stock in the subsidiary. Hence, the court disallowed the allocation of the intangibles income to the US parent company. Similarly, there are various case laws across the world which have ruled on the concept of non recognition. Now, coming to the point on how we can justify a transaction before the tax authorities. I feel it is best to have a robust transfer pricing documentation and other supportings, such as the contracts, the group transfer pricing policy, or any communications that throw some light on the actual nature of the transaction. They should be, all these documents should be kept in place. This will enable the tax authorities to identify as a first step the whole value chain and the functions and risk analysis of the multinational group. Over the last several years, various courts in India and worldwide have examined the issue of recharacterization in the context of transfer pricing. In India, courts have held that tax authorities can recharacterize the transaction in accordance with its substance only when the economic substance of the transaction differs from its form and the form and the substance are the same, but the arrangement in totality differs from that which would have been adopted by the independent enterprise behaving in a commercially rational manner. Now, coming to another important point of whether legally are the tax authorities allowed to disregard a transaction, especially in Indian context, under the transfer pricing laws. So, when we look at Chapter 10, Section 92 says, any income arising from an international transaction shall be computed having regard to the arm's length price. It says any income from an international transaction shall be computed having regard to the arm's length price. Further, Section 92 CA, which authorizes for the transfer pricing audit, it gives the authority to the assessing officer to refer the computation of the arm's length price in relation to the said international transaction. So, in my view, from the wording of our income tax laws, it is clear that the transfer pricing officer can only compute the arm's length price of a transaction. They do not have the authority to completely disregard a transaction. Though an AO, an assessing officer, may disallow certain expenses under Section 37 of the Income Tax Act on grounds of commercial expediency, the TPO cannot disregard a transaction completely. In the case of EKL Appliances Limited, the Delhi High Court has held that situations where recharacterization could be considered are exceptional and should not be a routine permissible practice by the revenue. On significance of the OECD guidelines that deal with recharacterization, the High Court noted as follows. It said the significance of the aforesaid guidelines lies in the fact that they recognize that barring exceptional cases, The tax administration should not disregard the actual transaction or substitute other transactions for them, and the examination of a control transaction should ordinarily be based on the transaction as it has been actually undertaken and structured by the associated enterprises. It is of further significance that the guidelines discourage restructuring of legitimate business transactions. The reason for characterization of such restructuring as an arbitrary exercise, as given in the guidelines, is that it has the potential to create double taxation if the other tax administration does not share the same view as to how the transaction should be structured. So, to summarize, while recharacterization is being undertaken by the tax authorities, complete disregard of the transactions is not that prevalent. Preparation of a robust transfer pricing documentation along with other supportings which highlight the actual conduct of the related parties helps to defend the scrutiny by the tax authorities. So, yeah, I think we can move on to the questions now.
Thank you so much, ma'am, for such an articulate and riveting speech. It was indeed an insightful session, and I'm sure it was a great learning experience for all of us attending the webinar today. We will now be taking the questions. So I request all the participants to kindly post their questions in the chat box if they haven't already posted it. So moving further to the first question, ma'am, could you clarify the difference between the substance and form of a transaction? Uh, and also, could you please give us an example, of a hypothetical transaction whose form differs from its substance?
Okay, it's a very good basic question on the subject. So, as I think I've discussed earlier also, form is the way a transaction is structured on paper, that is in the contracts. Form is determined by the contractual terms, while substance is the real nature of the transaction, the real intent or the actual way in which a transaction is undertaken. It is determined by the actual conduct of the parties. So, on paper, an entity may be a cost plus entity. However, the conduct of the party shows that it is much more than a pure cost plus entity. It is performing functions such as marketing, it is bearing certain entrepreneurial risks, etc. So, it cannot be classified as a mere cost plus entity. So, examples can be multinationals shifting income to a shell company in a low tax jurisdiction with few employees and little or no economic activity. So, a transaction with this kind of a cash box entity and its associated enterprise may be non recognized if it is not commercially rational. Another example can be a company has given share application money to its associated entity and it is pending allotment. So, the tax authorities may argue that this is in reality interest free loan since the allotment has also not been there and it's been pending for some time. So, the form is share application money and substance as per tax authority is interest free loan. Another example was, as I mentioned earlier, about the OECD guidelines, which it gives about the insurance that a company is paying 80% insurance. So, no other prudent businessman would pay 80% insurance. So, that is kind of the substance is actually shifting of profit outside. So, it cannot be considered as a real international transaction. Yeah.
Thanks, Bhavya. Actually, this was very insightful. And even when you were taking us through the judgment of EKL appliances in the Indian context, that was, very insightful there. So, what do you think are the common elements, involved in the determination of commercial rationality? I mean, the red flags that one should consider in this respect.
Right. So, So, commercial rationality, I think it means basically what makes business sense. So, if a transaction is making business sense for any corporate or any business house, then it will be considered as a commercially viable or a commercially rational transaction. The fact that similar transactions are undertaken by independent entities in the market will also go on to show that the transaction is commercially rational. Also, the fact that two independent third parties would be willing to enter into a similar transaction would show that the transaction is commercially rational. Now, your second question on red flags, I think I would probably rephrase it as some points that we should keep in mind while undertaking transfer pricing structuring or while defending a proposed recharacterization. So, most important is the functional analysis. So, what each entity is performing, how each entity is contributing, and what is the benefit that each entity is deriving. Everything should be documented. Next is documentation of the risk analysis. What risks each entity bears, undertakes. Is it truly a cost plus entity or is it as an entrepreneur or something else? Everything should be documented. Especially in case of complex interrelated transactions, they have certain common features that we need to look out for, such as where is the legal title to an item, where the ability to enjoy the principal benefits lie, and exposure to the principal risks associated with it, where do they lie. So the way to identify is to determine who undertakes the functions and bears the risks relevant to that transaction. So to summarize, especially post the DEMPE analysis guidelines provided by the BEPS action points 8 to 10, it has become imperative to prepare documentation that highlights which member performs which function and which member has control over the DEMPE functions. Which member is providing funding, for example, and other assets, and which members assume the various risks associated with the intangible. Also, on the red flags bit, I think I feel though it is very transaction and case specific, the red flags question that you asked, but any inconsistency between the actual conduct and the functions performed often lead to disputes in the Indian context, especially. So, suppose there is a communication between two parties which go on to say that the functions are much more than as has been laid in the contract. This will trigger additional scrutiny and questions from tax authorities. So basically all documents, social media profiles, communications, everything should be in alignment. So suppose you've opened a low end BPO like we were discussing, a BPO center, but the employees of the BPO center on their LinkedIn profile, they are saying we are engineers or we are MBAs from top schools. So they would not be working in a BPO, they would not be providing low end services. So everything has to go hand in hand and properly documented, so to show the real intent of the transaction.
So the bottom line I understand is a strong documentation, a strong
Yes,
transfer pricing
yes,
documentation.
that's very, very true. Yeah.
Thank you.
Ma'am, so the next question is how do you weigh the concept of accurate delineation of transaction in terms of substance over form or commercial rationality with Action Plan 8 to 10 that talks about transfer pricing outcomes in line with value creation?
Okay. So at first glance, the concept of accurate delineation is pretty simple. It is about assessing how the actual behavior of the parties to a transaction stacks up against what is provided in the written contract. So, actual conduct rather than the paper reality dictates the arm's length results. The concept of substance over form in transfer pricing has gained increasing popularity post the Action Plan 8 to 10 of the BEPS project. So, the action plans cover various aspects of transfer pricing, including intangibles. A robust guidance has been provided in Action Plans 8 to 10 on the TP aspects of intangibles, where more thrust is on identification of substance over form and then appropriate allocation of transfer pricing outcome aligned to the value creation. So it talks about value creation. Accordingly, the guidance has moved away from the concept of legal ownership to an approach of looking at who is contributing to the value chain for the development and management of intangibles. That means recognition of economic ownership concept rather than the legal ownership. The guidance has put a significant thrust on controlling the important functions, such as, like we've discussed earlier also, the DEMPE functions, which is development, enhancement, maintenance, protection, and exploitation, and controlling the economically significant risks arising therefrom. The guidance also specifies that the entities performing important DEMPE functions or contributing to the control over the economically significant risks may be entitled to an arm's length remuneration through a profit sharing element. So, to give you an example, in India, CBDT had issued a circular number 6 of 2013, which was much before the BEPS action points 8 and 10 came into play. So, by way of which CBDT gave certain conditions for the classification of a contract R&D development center in India. So this circular classified the R&D centers set up by the foreign companies into three broad categories on the basis of the functions, assets, and risks assumed. So the three broad categories were, first was the centers which were entrepreneurial in nature, second was centers which are based on cost sharing arrangements, and third was centers which undertake contract research and development. So what used to happen was everybody used to classify their R&D centers as a contract R&D center and charge a cost plus certain percentage of markup and use the transactional net TNMM analysis. So while the three categories which were enlisted by the CBDT in the circular, they were not watertight compartments. It was possible to distinguish them based on their functions and assets and risk. So in the first case, which was the entrepreneurial R&D center, it became obvious that the development center performs significantly important functions and assumes substantial risks. In the third one, which was pure contract R&D center, it was that the risks and the functions in such a scenario would be minimal, and the centers which are based on cost sharing arrangements, it would fall somewhere in between the entrepreneurial and the contract R&D category. So to summarize the concept of accurate delineation, um, it is about accurately delineating the actual conduct of the parties and assigning the relevant value on the basis of their actual contribution to a transaction or the benefit derived from a transaction.
Okay, ma'am. So the next question is, in the context of substance over form, do you feel transfer pricing is restricted to being an anti-avoidance measure, or it goes much beyond that?
Yeah, this is a good, interesting question. So, substance over form in transfer pricing is definitely an anti avoidance measure. The principle of substance over form was established to avoid that related parties enter into a contractual arrangement which fully complies with market requirements. However, actually, the parties are performing the intercompany transaction in a totally different way than it has been contractually agreed. So this would also alter the arm's length compensation. So as per our Income Tax Act, transfer pricing is a separate code in itself. The transfer pricing law was introduced to curb the practice of shifting of taxable profits outside India. The transfer pricing law was introduced, and when these rules were introduced, they were touted as specific anti-avoidance rules. So we can safely say that the transfer pricing is an anti-avoidance measure of the governments all over the world. However, if we talk about other than transfer pricing beyond the Income Tax Act, if we talk about transfer pricing beyond the Income Tax Act, the practical usage of transfer pricing goes much beyond just anti-avoidance. I feel these are just my views. So since I've been doing transfer pricing for a long time now, so transfer pricing gives you an indication on how businesses are run. For example, how they function, how they work. So how intercompany transactions are structured, for example. So it is an amalgam between economics, business knowledge, and tax laws. It will give you an insight into the pricing followed by different multinational groups Also, the transfer pricing documentations gives an insight on the entity characterizations. So transfer pricing reports are used while undertaking business valuations, for example. So in business world, transfer pricing definitely extends much beyond just anti-avoidance measure and beyond tax for that matter.
I think I'd like to put across saying transfer pricing is more like an art rather than just
I
to be
to
restricted to an anti-avoidance measure. Like you
Right.
said, transfer pricing reports being used for valuation purposes, etc. I mean, there is the usage goes much beyond being an anti-avoidance measure actually.
Yeah, that's very true. So, you know, it's like if you study tax, for example, so it doesn't just flow naturally that you will be able to do transfer pricing. It is much beyond than tax knowledge. It is
I
actually an
totally
art.
second that. Yes.
Yeah, yeah.
Thank you, ma'am. So the next question that we have is, do you see any impact that COVID-19 pandemic has brought, an impact of corporate restructuring that could in turn lead to non-recognition?
So, business restructurings, anyways, they attract a lot of scrutiny from the tax authority. And COVID 19 has forced many multinationals to change the way they do business. While some industries have enjoyed a boom in the past year, several multinationals are also experiencing significant disruption and changes. While COVID 19 has been an unprecedented and extraordinary event, the OECD COVID 19 guidance, it has defined it as a hazard risk and not as a force majeure event. So, as a result, in principle, the intercompany pre pandemic transfer pricing models and agreements continue to be valid and should not be renegotiated merely on account of COVID 19. If, however, MNCs wish to change their intercompany policies and agreements, evidence towards whether independent parties would do the same would be required. So, it would be important to identify any changes in actual relationship between group entities pre and post pandemic and the extent to which there arises a need to modify existing agreements and remuneration to depict evolved commercial realities. In case of tax controversy, commercially aligned agreements and TP policies would help in forming an essential base for any arm's length evaluation. In such cases, changes to business arrangements may attract possible business restructuring related exposures which would need to be addressed by the taxpayers. A few examples to show how COVID has altered the value chains can be so there has been a shift to digital marketplaces for a lot of businesses or e-commerce platforms. So from brick and mortar kind of stores, they moved to online marketplaces. In such cases, the relative contribution by digital marketplace has increased substantially during the pandemic. So this might lead to shift in the functions of different entities and their relative arm's length compensation. So there would be a need of restructuring within the group. For businesses traditionally using centralized sourcing also for their manufacturing or trading activities, COVID 19 has posed an enhanced risk of supply chain disruptions. So, for some industries, for example, this has resulted in decentralized sourcing mechanisms using alternate sourcing locations or suppliers. So, there are various COVID induced business restructuring or supply chain disruptions which would attract attention of tax authorities. However, the key would be to support the same with the help of adequate documentation to show that even an independent third party would do the same. So, everything boils down to having an adequate documentation, a complete documentation, and some material to show that an independent third party would enter into a similar transaction, that it is making business sense. It is prudent for a normal businessman to enter into this kind of an arrangement or a structuring of the business.
Uh, Ma'am, the next question that we have is, so what are the some potential repercussions of a great proclivity of courts to disregard transactions?
So in India, as I discussed earlier as well, in transfer pricing, non-recognition is not that common. But the approach more commonly followed by tax authorities is about recharacterizing a particular transaction. If we see transactions such as KPO versus BPO, AMPX, advertising, marketing, and sales promotion expenses, interest free loan, corporate guarantee commission. There are many examples in the transfer pricing case laws in which transactions have been recharacterized. The biggest repercussion of non recognition or recharacterization is that it can lead to double taxation. So it can lead to uncertainty for a lot of taxpayers. So I feel we need to be mindful of the fact that how the courts are accepting certain transactions. If we are able to justify the substance of the transactions with the help of a well prepared documentation, supportings, legal contracts, which give a clearer picture of the actual substance, it becomes easier to defend our case and defend the transfer pricing transaction. For example, rather than just saying it is a contract R&D service provider, we should provide more details regarding which function is performed by which entity in the group. So we should provide all this in our documentation itself. Plus our agreements, for example, our intercompany agreements should be clear. We should not just say it is a cost plus entity, for example. We should give more details in the agreement also about what functions would be performed by which entity. So probably we can give guidance, we can add some notes on who is undertaking decisions in the group, such as what level of employees are being employed by the entity. So these days, even the social media profiles, such as LinkedIn profiles of the employees, they come under the scanner, and they help the tax authorities to assess the kind of work which is being carried out by a certain entity. But having said that, the biggest repercussion of non-recognition and recharacterization is, I think, undue hardship to the taxpayers in the form of double taxation.
So I understand it's actually like a strong economic analysis or a FAR analysis which forms part of the documentation that is really essential to be maintained in addition to the supporting documents that you just mentioned about.
Yeah, and so mainly what I'm trying to stress, the point I'm trying to say is that all these documentations, they should have the actual conduct. They should be as close to the actual conduct of the parties. They should outline everything very clearly. So your agreements, your transfer pricing documentation, all your communications between the parties, everything should be clear. So it
Hmm.
should not happen that there is a contradiction between probably your transfer pricing documentation is saying something like it is a cost plus entity, and actually the agreement, as per the agreement, it says that it is an entrepreneur. So that should
Hmm.
not happen. So
Hmm.
yeah,
Makes
that is
sense.
the main
Yes.
thing. Yeah.
Yes. Thank you.
Uh, Ma'am, I don't think so. We have any more questions. So thank you so much. I think this has brought even more clarity on the topic. So now I take this opportunity to thank Ms. Bhavya Bansal Goyal, ma'am, and express my sincere gratitude on behalf of CCIT for accepting our invitation to address this session. We strongly look forward to having you again with us, ma'am. And without failing to mention, I would also like to thank all the participants who joined this session, without whom this webinar would not have been successful. And on behalf of CCIT, I assure you that we will continue to strive for knowledge, and in furtherance of the same, we shall continue to bring up such expert sessions to ameliorate everyone's taxation knowledge and understanding. Thank you. Have a good day.
Thank you, Bhavya.
Thank you so much. It was indeed my pleasure to be speaking here.
No, this was very insightful. This is quite, the topic that we really needed to know in transfer pricing. The topic on substance over form. and you've explained it in such like an easy format. It was very insightful actually.
I just hope I was able to do justice.
Totally. Thank you so much.
Thank you. Bye bye.
Thanks to
Bye.
everyone. Thank you.
Thank you. Bye.